Hi everyone, as you can see, it's a real pleasure to be in London today. We're taking you with us to meet with Nic Humphries. Nic is a senior partner and executive chairman of HG. Alterock made a 118 million euro total commitment across 3 HG funds with our 2022 vintage Alterock fund and Altalife. Louis Flamand is with him. Let's kick off.
Hi Nic.
Hi.
Thank you very much for taking the time to meet with us in your offices in London today. So on my way to London this morning, I tried to remember when I first met you. I think it was probably between 2007 and 9, probably 2009 actually, when you were raising HG6.
Yeah.
And since then I've been a long-term supporter of HG. The institution I represented before joining Alterock was an investor in all of your funds. I was on the advisory board of all of your funds. I co-invested with you. So I'm delighted to meet with you today. I'm delighted that also Alterock committed to your last generation of funds. So maybe first, could you please share with us the key milestones of your successful professional career?
Yeah, well, first of all, thank you very much, for your support, obviously, over a very long period of time. It's been a great business friendship, and also, obviously, for kind of Alterock's more recent support, both for our funds and pending for a new co-investment, which we're delighted to do with you. My career, in brief, is an electronic engineer originally, so techie. I then moved pretty much straight away into private equity and worked for the first kind of 10 years in mid-market European investors and with a US investor. Very quickly in that period I discovered that I didn't want to be a generalist, I wanted to be a software specialist investor. So I've been investing for 33 years in total, of which 30 have been focused exclusively on software. I joined HG in 2001, and the brief background of HG is it was a division of a large asset management business, and span out of that asset management business in 2001 as an independent firm. I joined as a spin-out happened, and I became the partner that focused on software buyout investing. Had other partners focused on other sectors. Between 01 and 07, software became about half of the firm, and as a result I got asked to take over and run the firm as chief exec in 07, and I pretty quickly persuaded my partners that we should focus exclusively on software and nothing else. So we became an exclusive software investor around about 08-09 when we first met each other. And that's really been the development of the growth of the business ever since.
What is your role today at HG?
So today I'm the kind of senior partner and executive chairman of HG. I use both of those titles because one tends to work in Europe and the other tends to work in the US. So that's my role today. Previously I was the chief exec.
Could you please introduce your firm, HG, and its history to us?
Yeah, I'm delighted to. So today, we're the largest private equity investor in software businesses in Europe. And very specifically, we do software buyouts. So that means businesses that are highly predictable with lots of very, very predictable revenues and lots of cash flows. I'm sure we can go into that in a little bit more detail. The history of the firm is that HG was originally a small division of a very large asset management business called Mercury Asset Management in the 90s. It span out of Mercury Asset Management in 2001, and I joined as the spin-out happened. And at the time, the firm was a middle market private equity investor across around about 4 or 5 sectors. And I was the person that was leading the technology or the software investing sector. For the first 3 or 4 or 5 years, 01 to roughly 06, that continued. And I was asked to take over as chief executive in 07, basically because at that time, software was approximately half of the business. And when I took over, myself and my partners decided that we would focus exclusively on software investing. So for the last 13 to 14 years, we've been an exclusive software buyout investor. For the previous 7 years, it was around about half of what we did.
Got it. And as the environment in private equity is getting more and more competitive, I think historical leaders of our industry have had to reinvent themselves and often specialize on areas where they have a key expertise, and many of them have failed to do so. I think HG is actually a very good case study of a successful modernization under your leadership. You touched on it, but could you please talk a bit more about that HG journey from a multi-sector fund to a fund focused exclusively on software and B2B technology services?
Yeah, very happy to, and thank you very much for the background as well. I guess where it started for us was that we looked at our own business in roughly 2006, 2007, and looked at it in the context of the private equity marketplace. The marketplace was probably 30 years old at the time, still growing. But like most markets, what tends to happen is that in a second generation, 30, 40, 50 years of a market, they tend to consolidate. And so we felt that what would happen over time was frankly what has happened, which is that you've got some very huge players that cover every form of alternative asset investing. And candidly, it was unlikely that that was going to be us, given our scale. The second strategy that people were adopting in Europe was then a geographic strategy to move across multiple countries and essentially be a country by country investor. And unfortunately, by 2007, there were 6, 7, 8 very good firms that were ahead of HG in doing that. But there was nobody in 06, 07 in Europe that was a sector specialist. And we felt, by looking at our own business and where we'd been successful, which was more than half of our profits and returns had come out of software investing, and also looking at the US, where perhaps sector specialization was a few years ahead, it was pretty obvious that the rise of sector specialists would probably be the next generation and the next wave of private equity investing. And we believed that we could be number one in that sector specialist, software specialist marketplace. So it really boiled down to understanding the market, understanding our competitive position, frankly a little bit of personal motivation, because we'd never wanted to be number 16 at anything in our lives, and so I didn't want to be the 16th firm to grow across Europe. We want to be the number one firm in software. So that was really the core of our decision. Obviously it was backed up by the fact that software is a long-term secular growth market, and so there was a bigger and bigger market opportunity each year as well. We wouldn't have preferred to be a sector investor in coal mining, for example. That wouldn't have been a great sector to pick.
It makes sense. And what do you think differentiates HG the most today as a buyout firm?
I think number one, it's our absolute discipline and focus. So all we do is software and tech services, B2B, and even within that market, we could get a little more technical and I could describe the subsectors of that market that we attack. And where we invest in those subsectors, we have literally 20 years of experience, and we put dozens and dozens of investment executives into each one, which gives us a scale that is unparalleled in Europe. Literally, we are 5 to 10 times larger in those software segments than any other player in terms of portfolio, capital deployed, capital returned, headcount, whatever metric you care to choose. So number one is that discipline and focus. Number two is the scale that we now have in those subsegments because of that focus for such a long period of time. And then number three is tied to scale, but because of the scale that we now have, we're able to employ operational specialists who come out of the B2B software industry, and we have 65 operational specialists full-time on our P&L, paid for by HG, and those operational specialists essentially understand every single aspect of a software business. So for example, we employ 3 to 4 people purely with a cybersecurity background full-time. These were very senior people within the industry. Most people who are making maybe 3 or 4 or 5 software investments wouldn't either have the interest for that person to join them and wouldn't have, frankly, the P&L to be able to afford that kind of person. And we're of a scale, and our portfolios of a scale, where we can employ 65 specialists like that.
What has been the long-term performance of your buyout fund?
So it's really simple. You just have to remember the number 3. So it's 3.3 multiple of money, 3.3 times multiple of money, and 33% IRR. My clients and colleagues in client services are going to tell me off because arguably it's 3.4 times the money, but I just think it's easier if you just remember the 3s.
Fantastic. And who are the typical investors of HG, and what is their average commitment to your funds?
So I'd say we're very, very fortunate that we have an incredibly wide number and large number of kind of clients, and they run from everything from very, very large sovereign wealth funds that commit billions of capital to us because they want to invest in scale, typically in our larger Saturn fund, all the way through to individual investors, and we have everything in between, endowments, some fantastic kind of supporters in lots of countries around Europe and around the world. So literally anything from $500,000 for some people, all the way up to kind of billions of dollars, and every increment in between, really.
Could you please elaborate on 2 to 3 buyout transactions of HG, explain how you source them, and maybe zoom in on how HG is creating value in those companies? I think I suggested 3 companies to you, IFS and Access, because Altaroc 2022 co-invested in those companies, and the last one, Visma, which you know extremely well, which we recently decided also to co-invest in with Altaroc 2023.
Yeah, delighted to. Talking about investment is what I love doing all day long. So let's pick IFS first. So IFS is a business that is based in Europe and is within a subsector that's called ERP. So this is basically bookkeeping and associated things for very large businesses. And a typical company that you'd think of in that area would be SAP or Oracle. And those businesses are clearly great in ERP software. However, there are particular types of industries where those businesses are not quite so good. They're not as specialized, and IFS has chosen to specialize in those industries, which is essentially asset-intensive businesses. So this could be an aerospace business, it might be a rail or an infrastructure business, it could be an airport, lots of other kind of examples, very big manufacturing businesses that clearly have billions and billions of dollars invested in assets, typically in many locations around the world, and understanding what those assets may do, either from a fixed asset or current asset point of view, how to maintain, how to improve them, is at the heart of those businesses being efficient. So IFS exists within this very wide category called ERP software, which is kind of many hundreds of billions worldwide, but has a very particular niche around asset-intensive industries that allows it to be the number 1 player in that industry. The history of the deal is we tend to sit back and think about the subsegments I described before. So one of our subsegments that we focus on is finance or ERP or payroll software, a back office, business critical, lots of recurring revenues, very mission critical and sticky for businesses. So all those characteristics describe typical HG deal. Within that kind of sector of ERP, we've really wanted to back a modern cloud or SaaS, software as a service business, for many, many years. So we've been looking for literally 7 or 8 years to find a business that specialized in heavy manufacturing ERP and was a modern SaaS player. And we've kissed many, many frogs over that time, and unfortunately we've not found many kind of princes or princesses. So we've looked at lots of businesses that frankly on the surface pretended to be SaaS and ERP businesses and really weren't. And when we spotted IFS approximately 4 to 5 years ago, we felt that they had the best product, the best suite, and it was a true cloud modern product for that industry. It also was a business that was used to dealing with scaled customers, so it had proven kind of customer examples as well. So once we latch on to that as a business that we think fits a long-term theme, we're willing to then track and build relationships with that business over a long period of time. That's precisely what we did. Over a 4 or 5 year period, we built a relationship with the existing investors and with the management team, in particular the chief executive, Darren Roos. That allowed us to kind of understand the business's performance, and in particular to see 3 or 4 years down the line whether the management team had achieved what they said 3 or 4 years ago. Hugely important. When we found all those things from a financial point of view stacked up, and the existing investors were keen to kind of realise part of their return, we basically stepped in and negotiated a bilateral transaction. So we were able to say to the existing investors, we recognise the value of this business. HG's strategy is very much to buy A+ businesses at A prices. We pay up for very good quality businesses because of their characteristics through recessions. And so we were able to step up and say, we know the value of this business, we recognise it's a superb quality business, and we're willing to negotiate what is an attractive price for you, the sellers, if you will give us roughly 6 weeks to complete a transaction. So that's how the transaction happened. What's the value creation plan for that business? It's really understanding that the business was on this transition to being wholly SaaS, but wasn't completely through that transition. So the current numbers as we bought the business looked pretty good, but they didn't have the 100% subscription that we know the business will eventually get to, or close to 100% subscription. And so we were able to spot a business where the financial fundamentals were very strong, but they would improve significantly over time as the business matured over the next 2 or 3 years. We thought the business could also do more M&A than it had done historically because it concentrated very much on the kind of core growth. And so a combination of that transition to SaaS would raise margins and actually raise growth medium to long term, and at the same time would give us an opportunity to do bolt-on acquisitions that would be very accretive. Those three things together give us what we think is a very attractive kind of mid-20s kind of potential IRR.
Thank you so much, Nic, for this detailed description of IFS. And what about Access, which was the second co-investment of Altara Global 2022 with HG?
Yeah, very happy to. Love talking about investments all day long. Let's talk about Access. So Access is a business that provides business critical software to different end market verticals, so hospitality, construction, etc. And Iris has chosen to kind of specialize in those verticals by finding a kind of core product that is mission critical, could be bookkeeping, could be payroll, and then wrapping a number of modules that are specific to that end industry around that core application. And they typically do that by building or buying the core mission critical application and then doing substantial M&A to integrate the other products around them. Access has been a business that's been on our radar for probably more than 15 years. We were very fortunate indeed to invest in the business out of one of our Genesis funds approximately 5 to 6 years ago. And that gave us the opportunity, when some other shareholders were looking to sell part of their stake, to bring Saturn 3 into the investment around about a year or so ago. So the key characteristics of Access are, from a financial point of view, to die for, to be honest with you. It's mid to high teens organic revenue growth. It's mid to high teens plus organic EBITDA growth. So even if the business didn't do M&A and we just levered that organic return, we should make a 20% IRR. And then on top of that, the business has got a very successful track record of completing substantial M&A each year and managing to get great synergies from that M&A that it does. So it can buy businesses at substantially below the price at which the overall group is valued. So that creates a huge amount of value as well. So it's a business that we've been delighted to be a shareholder in for several years through Genesis, and we believe that return that Genesis has generated, we should be able to continue in the Saturn 3 fund.
And the last one that we've just approved for Altara 2023 Global, Visma.
Yeah, well, we're delighted that you're coming on board with Visma. For us, the Visma journey is very long, as you know. We first invested in the business back in 2006. And we've had a very long journey where I've personally been on the board of Visma since 2006, and we in HG have been investors throughout that whole period. It's been a business that's generated a high 20s, low 30s kind of IRR over a kind of 16, 17 year period for us, which I guess is representative of what we like to try and do. We like to find long-term, safe, compounding businesses that generate attractive returns, but over decades, ideally. And we think that pretty much matches what our clients would like as well. The business is essentially a provider of mission-critical software to SMBs, small and medium-sized businesses. That could be payroll, it could be bookkeeping, it could be expense reporting, cash flow management, and all the things that sit around those kind of core applications. And it does that on a country-by-country basis in lots of what the management team of Visma would describe as small, esoteric and quirky countries. So this is Norway, Sweden, Denmark, Finland, that's their words, not mine. And since we've expanded the business into about another 20 countries across Europe. And in all of those markets, Visma tends to be the market leader in modern SaaS software for these SMBs. How we create value, pretty similar HG formula. The revenue line in Visma, because we're doing lots and lots of kind of sell-through and add-on modules to our customer base, grows at about 15% per year. The bottom line EBITDA grows at about high teens to 20% per year. And then on top of those great numbers, we manage to add substantial M&A that we acquire at lower than the Visma group multiple. You wrap that with a modest amount of leverage and it enables us to achieve a 25 to 30% IRR consistently over nearly 2 decades at this point.
Fantastic. Moving on to the environment, what's your perspective on the current environment? Is it a good time to invest?
I would say we think it's a very, very good time to invest, and it's a slightly tougher time to kind of realise investments, as most people would probably recognise. Clearly, rising interest rates and inflation, more than a year ago, has created a very different environment that we have to adapt to. I feel somewhat fortunate that it's like the environment I spent the first 10 years of my career in the 1990s. So I have seen 18% interest rates when I was working. Hopefully we don't go to that point again. But it's that kind of environment which I think is different to where we've been for the last approximately 2 decades. We still think it's an environment where you can find great businesses that are producing kind of great returns, but you have to be super selective and you have to take your time over those investments. So in a lot of ways, from an investment point of view, we're delighted. I'd rather this environment than the environment we had in 2020 and 21, where half of my colleagues are trying to persuade me to do crypto investments and I'm fending them off on a regular basis. So for us, as an investor in mission critical, predictable, steady, growing businesses, I think it's a very nice environment to be an investor. On the flip side, as a divestor, when we put existing assets in our portfolio that we want to sell, we frankly have learned about this market 20 or 30 years ago. And one of the big lessons for us was never buy B quality businesses or C quality businesses. Those businesses look great in a bull market, but they become extremely difficult to sell in a bear market, essentially because nobody knows what the EBITDA is going to be. And people can't predict the EBITDA. With all the business we buy, which are kind of A quality, repeat revenue, mission critical subscription, etc., the revenue and the profit is very predictable 2 and 3 years hence. So we may have a debate about the multiple you'd like to pay for them, but we don't have to debate the EBITDA because the EBITDA is incredibly predictable. And that's enabled us to sell businesses very consistently, even in this market, to both financial and trade players. So we've managed to generate liquidity for our investors. Not yet Alterock, I don't think, because it's fairly new, but that will be coming very soon. We've essentially generated a liquidity event every month for our investors in the last 22 months since January 22, and fingers crossed we'll be doing again the same this month as well. So we think that's entirely down to a long-term strategy that's about buying A-quality businesses that are buyable in almost any market by a trade player or a financial player.
And how do you see the private equity market evolve over the medium to long term?
I think it's going to get more competitive. I think it's going to consolidate. If you look at almost any other market that's in its second generation, first generation for private equity, roughly the last 30 to 40 years, growth pretty much for everybody. Second generation of a market tends to be about consolidation. I think you can already see those factors kind of playing out. And so we talked about this a little bit at the start, but I think in most consolidating markets, you either have to be huge and essentially you're the Ford or GM of your industry. You're a one-stop shop that does everything. Probably not a Ferrari or a Porsche or something of that kind of ilk. Clearly, that's not our strategy. Our strategy very clearly is, Patek Philippe, Hermes, Porsche, pick your brand. So we want to be large and substantial to be globally recognized. We think that's incredibly important, like all those brands are. But we also want to be absolute premium. And so we're prepared to avoid many opportunities that might be tempting in order to focus on what we do and to get better and better and better every single year at what we do to try and maintain premium returns and premium liquidity for our clients. Very much in the same way that if you look at the Porsche model of today is different to the Porsche model of 40 or 50 years ago, but you can see a huge amount of engineering as that model has developed over time. The same with kind of the Birkin handbag for Hermes, and same with kind of Patek Philippe. So we're very focused on trying to kind of think about those analogies, obviously slightly different industry, but applying that same philosophy to our industry and to HG.
Makes a lot of sense. And thank you so much, Nic, for your time. Thank you for your insight on the private equity market, on HG. And I think our clients will just understand why we've committed so much capital to your funds and also why we love to co-invest with you. Thank you again.
Pleasure to meet you. Thanks very much indeed. Thank you for your time.